Then, next thing, how can we raise funding? Because in our balance sheet we have this property, and sometimes companies are saying, especially in case of airlines, when you have these highly valuable assets like airplanes, uh, but these highly valuable assets have a steady second-hand market. So usually, if an airline purchases a plane, they are using it for 10 years, and after 10 years you need a major overhaul on the plane, and physically you can use it even for 30 years, or sometimes even 40 years. So if you are maintaining it regularly, changing the different parts, it doesn't matter. The problem is that you will be stuck with this asset. So maybe there will be modern engines, avionics, and so on. Usually the whole of the vehicle will be the same, so still, okay, now people start to use carbon fiber composites, but mostly everything is made from aluminium. So uh, the market is quite conservative in these terms. But even engine changes, so there were new engines introduced in the 2010s which provided fuel saving higher than 10%. And if you are able to cut 10% of your fuel expenditures, this can be really important. So these airplanes are quite thirsty, so sometimes even just fueling one airplane for longer flights, it can take $1 million US. So if we can cut it by 10%, it can be lucrative. So that's why many companies are saying that, okay, we are using this plane for 10 years, and after that we are selling it on the market, because after an overhaul you can use it for chartered flight, but not for daily flights, with higher price margin obviously. Or you can remove all the chairs from this, you can put a bigger cargo door on the side of the plane, and you can use it for freight, for cargo transportation, for decades, because there the profit margin can be much bigger. So the lowest profit margin is always in the passenger transportation. And in many cases, what happens that airlines are purchasing the airplanes, and after that immediately they are selling these airplanes to a leasing company, and after that they are leasing it back. Why? Because in this case they can mobilize a lot of capital, because after that the asset is still in their property, which matters a lot. So I will create an alternate saving again. So let's say lease. So the asset still will be accounted as their property because they are using it for longer than 1 year. Practically it's owned by the leasing company, but they can verify this or use this ownership, or realize this ownership, if they are not paid. So usually if one airline is going default, then you can see the next day on Flight Radar that their plane starts to fly on the airbase of the leasing company, or something which was designated as an airfield for the leasing company to store the fleet there. Because in case of non-payment you can take the asset back immediately. While in the case of a bank loan, then the company is going down into bankruptcy, then you have to run negotiations, so everything is going back and forth, sometimes even at the court. So you have to wait for months until you can realize you can get back some of your assets, if you are lucky and the company is not overly debted, and you get back nothing at all. So, and still after that you have to wait until you can sell this property. In terms of leasing, it's really simple. Payment is not coming in this month, then grab the asset and take it back immediately. So it's less riskier for the leasing company, and it's also very flexible for the companies which are using the lease, because in this case you don't have to apply for a loan, you don't have to provide any kind of financial data which provides that, okay, this company is good enough to take up this loan. You don't have to provide any kind of collateral for this loan. So it's faster. So usually the book says, so if you are checking the lecture notes, and somewhere is written, okay, right now I cannot see it, but so this flexibility is really good because you can get this asset within a month or 2 months. Many years ago I was even able to write an email to different companies which provided locomotives as a leasing for freight cargo companies, and practically this is where we can see that they are not just providing funding for the asset, but also they are providing different kind of services. So they are providing maintenance, and this is really good for us because if we can remove maintenance costs, maintenance personnel, maintenance equipment, spare parts, so we don't need a warehouse to store spare parts because everything is coming directly from the leasing company. Also we can cut enormous amount of costs, and sometimes in case of so this is the full service lease, but there is the wet lease. Yes, it's not just about maintenance and insurance, but also in many cases they are providing even personnel. So there are many airlines which are not using their own trademark. They are providing pilots, they are providing planes, and after that they are giving all this service package to other airlines for flying. And sometimes even you can see that, let's say Ryanair, and under there are small letters that, okay, this is belonging to this airline. So it also provides flexibility because if you are able to build a portfolio from your own vehicles, from leased vehicles, usually these contracts are not so long term. So you can see also here that this is for 3 years. And if you are able to see that, okay, the market right now is going down, then you are just not renewing the lease contract. So you are able to increase or decrease your capacities with way bigger flexibility than just using loan or equity to purchase these kind of assets. So this is also not just popular in case of airlines, but also it's really popular in case of logistics company which are operating trucks or even smaller vehicles like cars, fleet of cars, or these transport vehicles, where there is even a designated lifespan. So many years ago, Hungarian police had this contract to use a fleet of leased police cars with a lifespan of 100,000 kilometers. Because after that, obviously, engine will be used a lot, and sooner or later you are reaching a point at the lifespan when maintenance fees are starting to increase dramatically, and also price would decrease as well, so it would be hard to get rid of this. So there, in many cases, not just police are doing this, but also logistics companies as well, that okay, the asset reaches the designated lifespan, and after that they don't want to renew the lease contract. This contract will be terminated. You have the chance to purchase the asset at a reduced cost, so usually there is this residual value. In US GAAP, it's limited at 25%. In IFRS, there is no limit, so it's up to the leasing companies. And and you have the chance to buy this, but you don't want to. So usually there is an auction for these used vehicles, and after that you can buy second-hand police cars, obviously without the shiny lights on the top and the other fancy things. Just you can get, if I remember well, they were Ford Mondios or something, some like kind of such vehicles. So, and they were white if you were removing all the police tags. Okay, but the biggest problem always with lease contract is that the literature describes the definitions, but after that it's really hard to get any kind of pricing equation or pricing method, because usually leasing companies are sitting on this. Practically I was able to get some suggestions and procedures from a company which later on went down due to the subprime crisis, and I was able to construct at least a method which follows and copies the usual behavior, how leasing companies are defining the leasing fee. So at least we can do something like this. And let's create this one. So if we have to define a lease fee, practically we have 5 interest components. So this is where we should start. So the interest rate of this contract will come from this component. So the base rate is the leasing company's interest rate. So if we are just checking the database, so let's go back, market data. Banking sector curve. Okay, this is good. So at least we can have some estimation about pricing structure. So let's assume that we would like to have a long-term lease contract. So we are selling some of our properties to these leasing companies, and after that we are leasing it back for 10 years. It's a reasonable choice. So the share interest rate will be 4%, and practically we have this for the banking sector. Okay, yeah, and we have to put it here. So okay, so this is the R0, and next thing is depends on maturity and additional down payments. In this case I was not able to dig up anything, so how can we calibrate this one? So maturity, so this is supposed to be the term premium, and okay, if we are going up here, we can say that let's be conservative and let's use this number from here. So what was the worst term premium on the market? This was. So and down payment, yeah, there was absolutely nothing about no equation. So interest premium 2 is defined by the commission of the leasing company. Again, it's quite hard to calibrate, but let's say that 1 nice % can be good enough. At least later we can calibrate. So if it's too big, then we can reduce it, but let's assume to have something there. Okay, interest premium 3 is related to partner risk and the volatility of the asset price. Volatility, okay, so that's too much volatility. Partner risk. We have absolutely no data about the exact nature of the properties, so that's why we have absolutely no idea about the value of the property, and that's why the market price volatility of the properties. So we have to use just the partner risk, but in this case we can have this method. So practically we need the default rate, oh, I did not want it to have any kind of special formatting here. So obviously it's probability of default. And here we can ask the question that, okay, but which one, for which year? So if the business plan is credible enough, then still the bank can say that, okay, let's take the average of this. So let's say that I forget to change it to English, but average function is used here, so we can say that this is 30% is the average default rate. Time to default, in this case we have no idea. So to get any kind of exact timing for default, we need market data. So if we are checking the Standards and Poor's global ratings, annual global corporate default and rating transition study, it's available. Yes, this is available, and after that, so they are collecting the data since the 80s and collecting all the default stories and many other things. But what is relevant for us, that sooner or later, let's go back to the lecture notes. Yeah, global corporate default rate by industry. So there have to be a table like this. Yes, and so this is where we can see that, okay, aerospace, automotive, capital goods and such sector has such a default rate. So 2020 was not the luckiest year for them, but on average still we can say that these companies have some kind of tendency to go to default. So practically this is 2%. In our case it's 30%. So, so this is the conservative choice. So still we could say that, okay, it's 2% sectoral average. If we would like to use this one, okay, let's remove this from here. We will check it, that what is happening if we are applying 2%, but right now let's use the business plan. And also we can see other sectors like energy, natural resources, and so on and so on. But the next thing what we need here is from right now, if you are checking these companies, how many years are they viable? So what is the average default time what they need? So practically this is survival time. Oh, come on. Yeah, but this is rating. Okay, we can connect it to ratings as well, but I would like to have an industrial something. Ah, yes. Time to default from post-original ratings grouped by industry. Okay. So we can see 9.7. Okay. 3.7. Yeah. Oh, it was above the previous one. So they are next to each other. Okay, so let's copy this one here to remember that that was our source of data. And I'm also highlighting with coloring that it was coming from here. So if you are going back to the description, now we just have to divide this number with this number and multiply it. Yeah, we have already an annual data, so we don't have to multiply up with months. And this multiplier, due to capital reduction, it's coming from a Basel criteria system, and it was 2. So in the baseline description, so let's keep it as 2. Whoa! This will be quite expensive. So this is what is happening if we are using the corporate probability of default, and also let's check what happens if we are just using 2% of the industrial. Yeah, there are slight differences, so we have to choose which one to use, but this is the conservative, this is the market average. So okay, and additional services can be added in the fourth component. Practically, since we have absolutely no data about the structure of HR resources at the company, we are not able to reduce maintenance fees by removing personnel or outsource them. So yeah, let's set it to 0% because we don't want to have anything like this. So at the end of the day, interest rate can be a sum of these numbers or this number. So somewhere in between. We have 2 lease fees. They are a bit far from each other, but okay. Usually they are closer, just my corporate setup is quite crazy. And then after that we can have the lease fee. And in this case, just we have to take the asset price. So we can say that let's outsource. So let's say that we would like to mobilize, instead of using 100 euros as debt, so there is not there anymore, but we need still this 1 million US dollars as a cash. So let's increase, let's source out property. So we will using asset value 100 million euros, and after that there is this residual value, which is a percentage, where we can buy this thing back. As I remember or mentioned it, it's 25%. When I define this somewhere, and when I check the legislation, in US GAAP, this is supposed to be 25% at most. The international, so the IFRS standards, they have nothing defined there. Just okay, I need some kind of number, so let's use 25%. It could be higher, it could be lower. Right now we have no idea what is this asset what we are using for this leaseback contract, what we are selling and after that leasing. So we can assume that at least it will have the value of 25% 10 years later. So yeah, and also there is this reduction by 10%, which was also required by the US GAAP, but it was not discussed further that why is this there. In the IFRS also you can free to calibrate this one, but yeah, it was okay. Time 10 years, and after that it will be just present value calculation, because we just have to take the value of the asset, then multiply it with the. So we have to remove the residual value from this, and also we have to correct it with the mysterious 90%, and after that we have to divide this with 1 minus. So this will be an annuity. What you learned on corporate finance. Just I prefer to give the whole equation, not the and not using any function, because at least here we can see that 1 minus 10. Okay, and another bracket opens for the division with the R again. So from year to year we have to pay let's such amount of euros, or if we are lucky at the lease contract, wow, why are you increasing? You're not supposed to increase. Yeah, because the other okay, so or in the alternate situation, if we are able to convince the leasing company that we are like the market, then practically this would be the annual fee. And in this case, we just have to say that, okay, let's use the more conservative data here. So, in case of valuation, but in the PLS here, so our debt will be not increasing with this one. The property will be the same, because we still have, and this is the biggest benefit compared to rental. Because in the case of rental you don't have the property, and that's why you don't have the benefits of depreciation. So the lease has this huge benefit that still you have the depreciation, so artificially you can still reserve some cash, and practically this is, yeah, the paid lease fee, it's already there. So let's use the conservative numbers. Is it disastrous? Obviously it's more expensive, so right now we cannot see that why is this thing good for us. Sorry, not this one, this one. This is recognized as negative number. Okay, so I don't need any further correction. So what happens with the probability of default? This is practically the same. But I think that the value, yes, it's going down. So let's check the worst case scenario. Yeah, nope. That was the worst case scenario, so it's still open. The value is still bigger. So sometimes, okay, we did this with the lease contract, we are really happy with the lease contract, but it's completely useless to use this one. So yeah, so there are no magic solutions, so that's why we have to test all the different scenarios, and that's why we are sitting here today, because we can say that no, we don't need this kind of lease right now for this specific situation, for this company. Otherwise it can be beneficial, just not today. Okay, so that's all.
Thank you.